This short-term rental tax hack can save you lots on your taxes, but you'll have to act fast because it's going away soon. I'm going to walk you through how a client of mine saved over $130,000 on his taxes using cost segregation studies and bonus depreciation. Let's first start by reminding you what a short-term rental is. A short-term rental is a rental property with a stay of less than 30 days, and it usually takes place on a platform like Airbnb and VRBO. For example, I had a client that I was working with who owned a transportation business. He would do everything from Amazon Sprinter vans to limousines to van transportation, and he made over $750,000 a year in his business. So he was looking for a way to save money on taxes, and he decided he wanted to start investing in short-term rentals. Well, he found the perfect short-term rental in Florida, worth over $2 million. This place was amazing. It had a hot tub, it had a swimming pool, it had a view of the beach, it had a sport court. In addition to making 25% cash-on-cash return on his money, he was also able to learn how to save an enormous amount in tax savings. One of the significant benefits of owning a short-term rental is the ability to save an enormous amount on your taxes using accelerated depreciation. In order to do this, you must rent out your property for an average stay of less than 7 days. We all know that a short-term rental is technically a rental property, but under the Internal Revenue Code, if the average stay is less than 7 days, it's actually not seen as rental activity by the tax code. It's not considered as passive income, so you may be subject to be able to actually take those passive losses like depreciation and cut it across your W-2 or business income. I don't mean just a small offset of your income. You can end up paying 0 taxes on. You can unlock the power of bonus depreciation if you meet the definition of material participation under the tax code. Now, here's the key. If you are able to actively be engaged in the management of your short-term rentals, you will be seen as materially participating in the active management of that short-term rental, and now you can be qualified as a real estate professional. In other words, your rental income now becomes non-passive under the Internal Revenue Code and allows you to write off all that depreciation against your other income like your W-2 job or maybe your own business. To not get in trouble, you have to meet at just one of the material participation rules that we're going over here, and you must make sure that your average stay is less than 7 days. So after I talked to my client about the opportunities in front of him, he now understood all he needed to do was self-manage the property during the first year, and now he would be able to meet one of those requirements for material participation and unlock these amazing tax benefits. Does that mean you get to write off the value of the entire property? No, not exactly, but that brings us to our next point, cost segregation studies. When you purchase a property, you can break down the value of that property based upon the land, the actual value of the building itself, and the personal property. This allows you to take the value of an entire purchase price and separate it into bundles for what each aspect of the property is worth. For example, your cabinetry might be worth $60,000. The decking out on the backyard where you get a chance to sit out and fish, that might be worth $100,000. You're designating into valuations what each part of the property is worth. Now, why would we do that? The goal is to accelerate your depreciation so that you can recover more of the depreciation expense earlier in the process of ownership. Normally, a short-term rental, you have to depreciate over a 39-year schedule because the IRS will label this as a commercial property. But when you do a cost segregation study, you can take a large portion of the value of the property and accelerate it to a 5-year schedule instead of 39 years. So my client decided it was important to hire an engineering company to do a cost segregation study on his new Florida property worth $2 million. Now, the first thing he learned was that you can't really write off the land because the land can't be included in the cost segregation study. Why? Because under the Internal Revenue Code, land doesn't really depreciate like everything else does, so it can't be calculated into the overall tax savings. So after the cost segregation study, he learned that the value of the land was $500,000, but the value of the entire property was $1.5 million. Here's the good part. His study came back showing 25% of the value of the depreciable part of the asset was subject to an accelerated depreciation schedule. So normally what happens is he could take 39 years and now compress that into 5 years for 25% of the $1.5 million valuation. The most exciting thing is for a limited time, he could also do what's called accelerated bonus depreciation. Bonus depreciation is when you can actually deduct 80% of the value of the entire cost segregation study all in 1 year. My client's accountant found that he qualified for a bonus depreciation of 100% because he purchased the property in 2022. Well, there's a deduction of $375,000. If you talk about a 37% tax bracket, you're now calculating a total tax savings of $138,750, all in 1 year. But accelerated bonus depreciation is going away. In 2023, you can only take 80% of that value, and it only goes down from there. I'm just a lawyer, but I've had many of my asset protection clients save hundreds of thousands of dollars using this strategy. So reach out to a qualified real estate CPA as soon as you can. And by the way, once you do buy that short-term rental and you want to learn how to persuade an attorney not to sue you if something goes wrong, check out this video.